Hello, everyone, and welcome to our quarterly market overview. I'm going to share my screen and we're going to get started here. Hope everybody is staying nice and cool today. All right, there we go. Whoops. Okay. Hi, everyone. I'm Colette Snyder, JH Advisors. I'm a certified financial planner. Everyone on this call knows me, but I'm excited to talk to you today. We're going to do our quarterly market overview and talk about some of the things that happened last quarter, some of the things that are new here at JH Advisors, things that we think should be top of mind for you. And feel free at any time to unmute yourself and ask a question, or you can type it into the chat and I am happy to take live anythings. I'm just happy to see you guys. I'm happy that you're here. Okay, so I'll jump into it. I'm a certified financial planner. Obviously, we're independent fiduciaries helping clients plan and invest. Our office location is now the PNC. We didn't move, but PNC bought First Bank. So our building has been rebranded as PNC of Belmar, but the same place. And then, of course, we meet remotely as well, and our investment accounts are held with Schwab. There's a picture on here. This was actually last week. Our team went to a rage room and smash stuff for fun for my birthday, which is upcoming. So we were trying to put on our tough faces there, but it was a really good time. We got to break all kinds of stuff and listen to loud music, and it was great. My disclosures I always have up here, read those really fast and memorize them quickly. Well done. Okay. Again, we're going to talk about what's new, what's going on in the stock market, key drivers and risks. We're going to talk a little bit about AI. We're going to talk a little bit about oil. We're going to talk about interest rates and inflation and a couple other hot topics that are fresh. Okay. What's new with us? Let's start there. We're gonna start doing a hot take 5-minute videos. So I got this idea from another advisor, and the idea is that when things happen or new laws are enacted or new opportunities arise, I'm gonna do a quick little video and send it out in our email. We're also going to be keeping these on the website. We just sent one out, I think it was yesterday or the day before, and it was on the Trump accounts, also known as 530 accounts. A little video on what they are, videos for kiddos with a potential free $1,000 from the government. What they are, how to set them up, and if you're interested in that, check the website. The video's there. But I'm going to start releasing some of these videos sort of just as things pop up, just to keep you informed and keep you in the know. We're going to start doing a little bit more in our review arena. We've always, when we meet with you guys, we've always talked about your returns. We've talked about your income, but we're expanding a little bit. We want to start reaching into some of the more obscure, but also very important areas, such as planning for long-term care, doing a little long-term care analysis and needs analysis to see if your needs are likely to be met, if you can self-insure at the time long-term care becomes a potential issue. And then we're also going to look at opportunities for life insurance, if there are any, just to make sure that we have met all those needs. Rachel is our life insurance guru here at the office, so she's been pulling lots of quotes for all kinds of different products. Just an area that we want to analyze to make sure that we've checked the boxes. So we're going to talk about that. And then when you come in for your annual review, you've probably noticed for probably a year now, Rachel has been sending out an email before your review requesting data. So it's really important that we get fresh data for our reviews so that we can have better outcomes in our software. And so the things she's asking for are an updated expense plan. If you are an expense itemizer, not everybody is, that's okay. Some people like to give me a flat number. But for those of you who we've been doing a budget, or if you want to start doing a budget, you will get a link from Retirement Analyzer. That's our software, and it'll ask you to update your budget. So if you could please get that done before you come in, then we'll have a really great discussion and we won't have to be digging through our credit card receipts. The other thing is if you have time before your meeting, please log into ssa.gov, Social Security Administration, and pull your most recent Social Security statement if you are not taking it yet, because we want to use that to strategize when we might start taking it. If you're already taking it, probably don't need that information. So you'll get an email from Rachel that asks you for some of this data. If you can prepare and bring it or send it to me in advance, I really appreciate it. It just adds a lot of value to our meetings. Um, we're also going to start talking more about Roth conversion strategies and how we can be strategic about moving qualified money, so money that's in your 401k or IRA, moving that money into a Roth account strategically before you hit your RMD age. For some of you, it's 73. For some of you, it's 75, depending on what year you were born. But we really want to be doing our due diligence and looking for those opportunities to move that money into a Roth bucket in increments to prevent the larger RMD situation that sometimes we run into. So that's something we've discussed with a lot of you, but we're going to make it more of a every meeting practice. It's going to be more integral into our planning. We have a new quarterly or biannual financial checkup calendar. I'm going to share that with you next. We want to help you stay on track all year, not just the one time I see you, because everybody has different meeting times. Sometimes I meet with you in the spring, summer, fall, winter, but there's little things that we can be doing throughout the year just to stay on top of our financial health. So, we're going to be sharing this calendar with you, but then I also wanted to open the door for folks who might want to meet more often. If you would like to meet more than once a year, say twice a year or even quarterly, please email my office and let us know that you'd like to be added to a quarterly or biannual list, and we will reach out in the increments that you requested and try to schedule those appointments for you. You might have noticed that we had some emails going out there for a couple weeks, and it was from our Advizon software that most of you are familiar with, our performance software. And they were coming out weekly and showing you your weekly performance. That was an automated email that went out to everybody. I made the decision to stop those emails when I received some concerns about data security. So if you saw those emails or if you want those emails, again, please reach out to my office and just let us know. Please send me the weekly emails. We can re-enroll you in that program. I just didn't want to blanket and send it to everyone in case they didn't want those. So please reach out and let me know. Also, Joanne, the artist, I have a little picture here of her glass. Everybody's asking about Joanne. She has been very busy producing all these beautiful pieces of art. She's in galleries all over the place in Taos and Salida and Idaho Springs. And she's making beautiful art. And she is still available if you want to meet with her. We have to call and just find out when she's going to be in the office. She's coming in a consultory sort of way, helping when needed. But if you want to meet with her, she is available to you. Just give us a heads up so we can wrangle her back from the galleries. Okay, here's our little on-track calendar. I'm not going to go through this in detail with you right now. Just wanted to give you a little idea of what it looks like. We'll be sending this out. We will be sharing it with you regularly just to help you stay on track and know what kinds of things you should be thinking about as the year moves along. Again, if you want to be on a different schedule for reviews, let the office know, please. Okay, let's get into the market. What happened last quarter? Well, you guys probably heard about SpaceX's IPO, initial public offering. That means the company went public and sold little pieces of themselves, little pieces of stock, to the public. And it was really exciting. It was the largest IPO ever, which is not surprising considering the hype. I think the initial share price was about $135 per share. At the peak of its excitement, I think around June 14th, it was up. I think it was over $250 a share. I checked today, it's actually below its initial price. It's at about 133. The reason I bring this up is because a lot of people have been asking about it. It's very exciting. But it's a really great example of why we want to stick with our plan and cautiously invest in things that we're interested in. So if people have come to me and said, I really want to get into SpaceX, my advice has been, we can buy it, but we want to wade into it slowly because when companies have an IPO, the stock is all over the place, right? Because they're not quite sure where it's going to settle. Where is the sweet spot for that price? So we certainly can, if that's something you guys want to talk about. If you are in our more I should say most aggressive strategy. We did add a SpaceX position to that last week. Um, the kind of bigger story is that there's this new public excitement in IPOs. There's been quite a few years where not a lot of companies went public. They didn't really see that there was going to be good value in it, but because there was such success with SpaceX, now Anthropic and OpenAI are considering IPOs later this year. Those are both AI companies. So just exciting opportunities for investors to get in on companies that well, I hear about it all the time. You probably heard about OpenAI. That's ChatGPT. I know I use it. I know a lot of you guys use it. Yeah, they're considering a public offering. Other highlights, the AI trade broadened. I'll get to that on another slide. Despite elevated interest rates, companies continued strong earnings. Stronger than analysts expected. Companies have been doing really well, even though interest rates have been elevated. We'll get into that a little bit more further along. We also got a new Federal Reserve chairman. Those are the folks that decide how expensive money is going to be to borrow. The Federal Reserve is made up of a bunch of bankers, essentially, and they decide when we're going to raise interest rates. So this new individual, his name is Kevin Warsh. This is probably not very exciting to you guys, but he's going to be sort of leading the charge on whether to raise or lower interest rates. And again, I got a whole slide on interest rates. We'll get into that. The other exciting thing is that the index is all three of the major indexes. So the Dow Jones Industrial Average, the S&P 500, and the NASDAQ hit record highs this quarter. Super fun, super exciting, right? But I want to remind everyone about the value in your plan. The value with working with a financial advisor is more than just having really great returns in the stock market. In fact, if you are invested in the stock market and you have some diversification, you should have been doing really well these last few quarters. So our clients have been doing well, you guys have been doing well, but that's really not the value that we bring to you. Of course, we want your money to earn, we want your money to grow, but there's so much more that we do in the comprehensive planning that I'm going to highlight today to just remind you why you hired us and why we can help you. Okay. There's a lot on here. I'm not going to get into the weeds on this. This is sector performance. So what did well last quarter? What didn't do well? It's more of the same. Technology, AI, continuing to accelerate, continuing to grow. One of the positive signals is that AI has broadened. That means that instead of everybody just getting excited about the idea of AI, it's getting into more areas. So there's more opportunities for the wealth to create, for the investment, I should say, to create wealth. So cloud spending, corporate earnings, all that's, it's showing that the AI bubble, if you will, is getting a little bit more solid footing into real revenue producing companies. So that's good. We like that because we talked in the last one and probably the previous one about the AI bubble, and we'll talk about that a little bit. Industrials, so building things did well because they're building a bunch of stuff. A lot of it is data centers and electricity infrastructure for AI. Financials did well, so banks did great. Banks just had earning reports yesterday that came out really big, really high profit margins for the banks. A lot of it is because interest rates remain high, and so they are able to charge more for loans. So banks are doing really well. Companies tied to innovation, infrastructure, and economic activity continue to drive market performance. It's more of the same. What struggled? The stuff that usually struggles when technology and financials excel, or I should say when technology and industrials. So utilities, real estate, and consumer staples. So those are our defensive stocks. Those are the ones that we go to when the market maybe isn't accelerating, or maybe it is declining, or maybe we're in sort of a business cycle slump. So those are our safer things. People have to pay their utilities, right? Real estate slumping because, well, interest rates are still high. It's still really expensive to get a loan, to get a mortgage. So defensive sectors fell behind as rates stayed high. Um, let's see. I'm looking for my chat thing. Nope. Okay. Okay, let's see. Okay, AI technology growth, opportunity, and investor debate. So I kind of touched on this. It's the leading sector of growth in the last quarter, but it's expanding. So it's helping not just the chat GPTs, but industries are adopting it across the board to help them make better business decisions, to have better customer service, to get better data, to be better businesses. So that is turning a profit, and it's really good for the stock market and the economy. At the same time, investors are debating whether the rapid pace of data center construction will generate sufficient long-term returns. So there's all this excitement, all this momentum. Let's build everything. But then what is that actually going to look like down the road? That's another component of a bubble bursting. Like, where does the rubber meet the road as far as how much of this can we use and how much of this can we monetize? Growing concerns about high capital costs to build a business, energy demand, and whether AI can keep pace with current investment levels. So more bubble talk, like where is this going, is sort of the question. We know that it is profitable, but to what degree? So it's a powerful growth tool, but a lot of investors are focusing on which companies are going to be the Googles and which companies are going to be the Ask Jeeves, if you will accept my reference for the AI, for the tech bubble, things that succeeded versus things that went by the wayside. This is a cool graphic. I like this. It shows interest rates and inflation. Oops, I don't know how to get this full screen mode I'm in. Shoot. Okay. Sorry, guys. Still figuring out Zoom here a little bit. Okay, so inflation continued to cool in the quarter. You heard a lot in the news about inflation going up because of oil. Yes, that is true to some degree, but overall, inflation has cooled, moving slowly, ever slowly towards the 2% target, which is what the Federal Reserve is aiming for. So this is a cool graphic. The red line is CPI, the Consumer Price Index. So that's all the stuff that we pay for. And then the core CPI is all the stuff we pay for, excluding food and energy. So the red and blue line are inflation. You'll look back at 2022, inflation was really high because we were coming out of COVID. Everybody wanted stuff, and there was not a lot of stuff to sell because we had been shut down because of COVID, right? So inflation, you guys remember, it was like 9%, super expensive. So then this stair-stepping black line here is the Federal Reserve inching up interest rates to combat inflation. They're saying, all right, everybody, you want too much stuff. We got to make stuff more expensive so that demand slows down so supply can catch up. So as you can see, the lines kind of converge here. And they're all making their way towards this dashed line, which is the inflation target rate of 2%. Now we're not there. You can see that the Federal Reserve still has an elevated interest rate. I mean, elevated is relative. Historically, it's not very high, but for what we're used to, it is higher. And we're getting some of these inflation numbers down. In income, or I should say, and here comes the war, right? We have a slide on that, I think, next, and we'll talk about how the war in Iran and how the closing of the Strait of Hormuz could affect and is affecting inflation. But right now, basically, the Federal Reserve is holding interest rates steady. Everybody thinks they probably will continue to hold them steady. It's like a wait and see situation. But there's a more likelihood of a rate hike than a rate drop before the end of the year, as it stands right now. So we'll see. Time will tell. Um, oops. Okay, this chart over here is Crude oil. So this is the price of oil. You guys have probably noticed at the pump that it's kind of all over the place. You've heard it on the news. Oil is a very reactive substance. So it reacts very quickly to the news. When there is an announcement that there is a trade deal or an escalation in, military activity, the price of oil reacts very quickly to that. And of course, we don't like higher prices at the gas pump, but um, oil is integral and everything in our economy. Of course, we use crude oil to make things, plastic things, and then we use it to transport things. So the price of oil has a direct impact on the rate of inflation here. So the issues in Iran, they just restarted earlier this week. I'm sure you heard. It's making it more difficult for the Fed to consider dropping rates because, again, the price of goods is going to go up. They're going to have to raise interest rates to combat that. So we're watching it. We'll see. It started to settle down a little bit. It's not quite as reactive. I think the market gets kind of used to the geopolitical chaos at some point, and starts to not react so quickly with it. For example, we pretty much restarted the war on Monday, and the market continued to go up or flat. Um, so we'll see. Hopefully, things there settle down soon. But the longer that the Strait of Hormuz remains closed, the more likely that the effects of not having the flow of oil move the way it's supposed to will be longer lasting in our own inflation understanding. So they say there's like a saying that's like up like a rocket, down like a feather. So gas prices go up like a rocket and then they come down like a feather because it takes a while to recover when there is a disruption like there has been. So we will see, but it hasn't been as bad as a lot of people have thought, I will say, is probably the takeaway. I'm going to stop sharing for a second because I can't see the chat. Okay. If you have a question, just shout it out if you don't mind. For some reason, I keep sharing my screen and the chat goes away, and I don't want to accidentally ignore your question. Okay, so back to my presentation here. Oops. Okay, this is the S&P 500 in the last 6 months. S&P 500, Standard and Poor 500, the 500 largest companies in the United States. Just to kind of show you what it's been doing, we had a little dip there in the spring. People got nervous about AI and backed away from tech and got a little defensive. And then they recovered and started ticking back up again. I like to show this during our presentations just to kind of give you an idea of how things have been going. Here's 1 year. So generally trending up, except for that little blip there in the spring where things went down. And then here's 5 years. I like to show this one in particular to give us sort of an idea of where we are in space, orient ourselves a little bit. Looking over here at the edge of this chart, looks like we're pretty much at the top. The market's been really strong. It's been really great. This is a great opportunity for me to remind you that if you have a cash need that you have been thinking about, if there is a project or a trip or something that you think you might want to pay for and you want to use your investment account to pay for it, now's the time. It could be the time because markets are high. It's a sell high, buy low is the goal, right? And I'm not saying that this is as high as it's going to go. I hope it continues to go up. But if there is something that has been on your tip of your tongue, please let us know so we can create the cash and make sure that that cash is available for you while we are in calm waters. Okay. Second quarter takeaways. I covered a lot of this already. Labor market continues to be pretty steady. Labor market unemployment, it's still below 5%, 4.2. So you kind of hear mixed stuff in the news about hiring and firing. They call it like a frozen job market where there's no hiring, but there's no firing. People are just kind of stuck. They don't really know what to do. Um, it's been pretty resilient, I guess, is the word. So, you hear a lot of negative stuff, but for the most part, if you want a job, you can find one. But it's very different depending on what industry you're in, of course, and which industries are expanding and which are contracting. Overall, though, good news. Um, corporate earnings have been great, as I mentioned. Gross domestic product, how much stuff our country produces. They're estimating that still hasn't come out the final number, around 2.2% annualized. So that means, yeah, the country's growing, not as probably as fast as we would like to, but healthy, good data for the fundamentals. We always talk about the fundamentals, like are the bones strong? Is the foundation secure? And right now, all signs are pointing to yes. Areas of concern. Elevated interest rates. It makes it really difficult to buy a house, as you know, but then it also makes it really difficult for small companies to grow when the cost to borrow money is so high. So pressure on interest rates will, to some degree, limit economic growth. Geopolitical uncertainty, gosh, it's all we hear about, right? Is the constant back and forth with Iran. It continues to present pressures and problems, and we're going to have to watch it. It, affects supply chains and market volatility globally. So of course, we're always watching that. And then consumers are becoming more selective with discretionary spending because the cost of living is going up, and there has been an uptick in debt concerns, people defaulting on loans and getting behind on their credit cards. So there is a little concern that people are becoming stretched, especially on the bottom half of the K-shaped economy. We talk about the K-shaped economy. You picture a K and the top part's going up. The wealthy are doing fine and doing better. And then that's better. And then, the lower end is doing worse. So if you're in a higher income family, you're likely not seeing a lot of negative effects. If you're on the bottom half of that, things are getting more expensive and you're getting squeezed more. Expectations for Q3, summer doldrums. So Q3, this next quarter, is historically the worst quarter of the year. It's just kind of a blah quarter, typically. The next few months, not a lot of activity. A lot of people are out on vacation and stuff. So we don't expect a ton of growth in this third quarter. But then fourth quarter is historically the best quarter of the year. So we'll expect a little slowdown, and then hopefully we'll see a pickup after that. But of course, you never know. Um, Social media. Okay, I want to touch on this real quick. I've had a lot of people come in lately and say, I have been watching YouTube videos and TikTok videos, and they are making me nervous because they're saying there's this huge planning strategy that I'm missing out on, and that only they can do it. And a lot of it is Roth conversions. But there's sort of this marketing spin that people are putting on it. Like, this is the fix all for everyone, and it needs to be done today. Um, they're presenting it as a one size fits all solution, and it's their recruiting, it's their baiting technique to try to get new clients. So let's talk about what it actually is. It's fear-based marketing. They're saying cryptic things to make you think that it's not just Roth conversions, tax planning, retirement income planning, and investment strategies. That's what they're presenting. They're just sort of adding this flair to it. These are valuable tools and they're considered in your plan every year. And your goals and your circumstances are unique to you. A lot of these things will say, again, this is the solution for everyone. They need to move all of their IRA money into Roth right away. And we've actually had some people come in who, unfortunately, went with some of these outrageous tax conversion strategies, and they were hurt pretty bad because you guys know if you convert a lot of money to Roth in 1 year, you pay income on all of that in 1 year. So just be aware of those kinds of fear-based marketing techniques. If you have a question about something that you saw online, please bring it to the office. And we can talk about what it means and make sure that that's something that we are already putting into your plan. And if we're not, we will. Um, your plan is not built around the latest trend. It's built around goals, your timeline, your tax situation, and your overall financial picture. Um, I'm missing one. I wanted to talk about, I must not have saved it. I wanted to talk about, oh yeah, I probably just didn't put it in here. Real quick, going back to what's new at JH Advisors, follow us on social media. As I say, stay away from social media. No, we have good content on social media. But if you are on YouTube or TikTok, you can follow us. We do have accounts. Marisol and I do some fun things on there, educational things, silly things, helpful things, and all of our links are in the emails that we're going to send out these hot take videos. So you can click on, the little YouTube icon and you can follow us. I think I just forgot to say that. I think that was the last thing in my brain. Okay, so this is what we always show you guys. Markets are just one piece of your plan. There's all this other great stuff. That's really where we feel like we bring value as certified financial planners. Anyone can get you money in the stock market, but what does it matter if you don't get to keep it because it gets taken away by taxes, or it gets taken away by higher Medicare premiums because you're in a higher tax bracket, or it gets taken away by the really expensive potential cost of long-term care insurance. So we really feel like where we bring value is in the comprehensive plan, looking at all of the pieces to the pie and making sure they all fit together so that you get to enjoy your retirement and not stress out about these things. Some sources and disclosures. I don't know, my team's on the call. If I miss anything, you guys can unmute and pipe in. Any questions for me? I'm gonna stop sharing my screen so I can see. Okay, I don't see any chats. Anybody have any questions? If you are watching this recording, you can email me the questions. We'll send this out to the whole group as we always do. Anybody? Anybody? Any questions? I'm gonna make it awkward.
No questions, but always good information.
Okay. Thank you, Leslie. No, I'm just teasing. I'm giving you a minute to think. Yes, please give me your questions. Oh, I see Beverly unmuted. Did you have something you want to say?
I just wanted to say great information on your Trump thing. I watched that on YouTube. And
Oh,
although my
good.
children are too old to benefit from it, I think it's fantastic.
Good. I'm so glad that you saw that. And just tell everybody. And I'll just say it again on here. If you know of a kiddo that was born between January 1st, 2025 and today, and then it goes all the way through 2028. So there's 4 years of kiddos. If they were born in that 4 year period and they are a US citizen, they qualify for $1,000 from the federal government, and you can do it through its trumptaxsomething.org. It's in the email where the website is. You create an account and you get the free money. I've got a little explanation on there about whether or not you should open the account if you don't get the free money and whether or not you should contribute to the account. So watch the video and tell your friends because it's free money. Everybody, all the little kids, it's free money and it's for their retirement, which is kind of a new concept, right? Like a baby retiring. But the idea is start young, invest, and then in 65 years, you won't have to rely so heavily on Social Security because we set this up for you. And it's been growing. It's kind of like a baby IRA, which is a great,
Yeah,
really long-term plan.
it was fantastic. I really, really appreciated it. We're in the kind of that catch situation where our kids are too old for
Mhm.
us to set it up, and they're probably too young for us to see grandkids that we could help set it up for in that
Mhm.
those years. But thanks. It was really informational, really good.
Thanks for the feedback. That was the first one that I've done. And if you have any ideas of hot takes that you want me to talk about, shoot them my way, send me an email, and I'll do a quick little video on it. I just love the idea of getting as much education to you guys as possible. Um, thank you, Beverly. Thank you, Leslie. Anybody else have anything before I log off? If not, thank you so much for joining me. Have a wonderful rest of your day, and I will see you next quarter.
Thanks.